I'm going to talk a bit about the U.S. economy, and then I'll discuss recent developments in global commodity markets, which are affecting both the U.S. and world economies, and then I'd like to conclude with some thoughts on prospects for monetary policy. U.S. economic growth so far this year looks to be somewhat slower than expected. Aggregate output increased at only 1.8% annual rate in the first quarter, and supply chain disruptions associated with the earthquake and tsunami in Japan are hampering economic activity this quarter. A number of indicators also suggest some loss of momentum in the labor market in recent weeks. We are, of course, monitoring these developments. That said, with the effects of the Japanese disaster on manufacturing output likely to dissipate in coming months, and with some moderation in gasoline prices in prospect, growth seems likely to pick up somewhat in the second half of the year. Overall, the economic recovery appears to be continuing at a moderate pace, albeit at a rate that is both uneven across sectors and frustratingly slow from the perspective of millions of unemployed and underemployed workers. As is often the case, the ability and willingness of households to spend will be an important determinant of the pace at which the economy expands in coming quarters. A range of positive and negative forces is currently influencing both household finances and attitudes. On the positive side, household incomes have been boosted by the net improvement in the job market since earlier this year, as well as from the reduction in payroll taxes that the Congress passed in December. Increases in household wealth, largely reflecting gains in equity values, and lower debt burdens have also increased consumers' willingness to spend. On the negative side, households are facing some significant headwinds, including increases in food and energy prices, declining home values, continued tightness in some credit markets, and still high unemployment, all of which have taken a toll on consumer confidence. Developments in the labor market will be of particular importance in setting the course for household spending. As you know, the job situation remains far from normal. For example, aggregate hours of production workers, a comprehensive measure of labor input that reflects the extent of part-time employment and opportunities for overtime, as well as the number of people employed, fell remarkably by nearly 10% from the beginning of the recent recession through October 2009. Although hours of work have increased during the expansion, this measure still remains about 6.5% below its pre-recession level. For comparison, the maximum decline in aggregate hours in the deep 1981-82 recession was less than 6%. Other indicators such as total payroll employment, the ratio of employment to population, and the unemployment rate paint a similar picture. Particularly concerning is the very high level of long-term unemployment. Nearly half of the unemployed have been jobless for more than 6 months. People without work for long periods can find it increasingly difficult to obtain a job comparable to their previous one, as their skills tend to deteriorate over time and as employers are often reluctant to hire the long-term unemployed. Although the jobs market remains quite weak and progress has been uneven, overall we have seen signs of gradual improvement. For example, private sector payrolls increased at an average rate of about 180,000 per month over the first 5 months of this year, compared with less than 140,000 per month during the last 4 months of 2010 and less than 80,000 per month in the 4 months prior to that. As I noted, however, recent indicators suggest some loss of momentum, with last Friday's job market report showing an increase in private payrolls of just 83,000 in May. I expect hiring to pick up from last month's pace as growth strengthens in the second half of the year. But again, the recent data highlight the need to continue monitoring the job situation carefully. The business sector generally presents a more upbeat picture. Capital spending on equipment and software has continued to expand, reflecting an improving sales outlook and the need to replace aging capital. Many U.S. firms, notably in manufacturing but also in services, have benefited from the strong growth of demand in foreign markets. Going forward, investment and hiring in the private sector should be facilitated by the ongoing improvement in credit conditions. large businesses remain able to finance themselves at historically low interest rates, and corporate balance sheets are strong. Smaller businesses still face difficulties in obtaining credit, but surveys of both banks and borrowers indicate that conditions are slowly improving for those firms as well. In contrast, virtually all segments of the construction industry remain troubled. In the residential sector, low home prices and mortgage rates imply that housing is quite affordable by historical standards. Yet, with underwriting standards for home mortgages having tightened considerably, many potential home buyers are unable to qualify for loans. Uncertainties about job prospects and the future course of house prices have also deterred potential buyers. Given these constraints on the demand for housing and with a large inventory of vacant and foreclosed properties overhanging the market, construction of new single-family homes has remained at very low levels and house prices have continued to fall. The housing sector typically plays an important role in economic recoveries. The depressed state of housing in the United States is a big reason that the current recovery is less vigorous than we would like. Developments in the public sector also help determine the pace of recovery. Here too, the picture is one of relative weakness. Fiscally constrained state and local governments continue to cut spending and employment. And moreover, the impetus provided to the growth of final demand by federal fiscal policies also continues to wane. The prospect of increasing fiscal drag on the recovery highlights one of the many difficult trade-offs faced by fiscal policymakers. If the nation is to have a healthy economic future, policymakers urgently need to put the federal government's finances on a sustainable trajectory. But on the other hand, a fiscal consolidation focused on the very near term could be self-defeating if it were to undercut a still fragile recovery. The solution to the dilemma, I believe, lies in recognizing that our nation's fiscal problems are inherently long-term in nature. Consequently, the appropriate response is to move quickly to enact a credible long-term plan for fiscal consolidation. By taking decisions today that lead to fiscal consolidation over a longer horizon, policymakers can avoid a sudden fiscal contraction that could put the recovery at risk. At the same time, establishing a credible plan for reducing future deficits now would not only enhance economic performance in the long run, but could also yield near-term benefits by leading to lower long-term interest rates and increased consumer and business confidence. Let me turn now to the outlook for inflation. As you all know, over the past year, prices for many commodities have risen sharply, resulting in significantly higher consumer prices for gasoline and other energy products, and to a somewhat lesser extent for food. Overall, inflation measures reflect these price increases. For example, over the 6 months through April, the price index for personal consumption expenditures has risen at an annual rate of about 3.5%, compared with an average of less than 1% over the preceding 2 years. Although the recent increase in inflation is a concern, the appropriate diagnosis and policy response depends on whether the rise in inflation is likely to persist. So far, at least, there is not much evidence that inflation is becoming broad-based or ingrained in our economy. Indeed, increases in the price of a single product, gasoline, account for the bulk of the recent increase in consumer price inflation. Of course, gasoline prices are exceptionally important for both family finances and for the broader economy. But the fact that gasoline price increases alone account for so much of the overall increase in inflation suggests that developments in the global market for crude oil and related products, as well as in other commodities markets, are the principal factors behind the recent movements in inflation, rather than factors specific to the U.S. economy. An important implication is that if the prices of energy and other commodities stabilize in ranges near current levels, as futures markets and many forecasters predict, the upward impetus to overall price inflation will wane, and the recent increase in inflation will prove transitory. Indeed, the declines in many commodity prices seen over the past few weeks may be an indication that such a moderation is occurring. I'll discuss commodity prices further in a moment. Besides the prospect of more stable commodity prices, two other factors suggest that inflation is likely to return to more subdued levels in the medium term. First, the still substantial slack in U.S. labor and product markets should continue to have a moderating effect on inflationary pressures. Notably, because of the weak demand for labor, wage increases have not kept pace with productivity gains. Thus, the level of unit labor costs in the business sector is lower today than it was before the recession. Given the large share of labor costs in the production costs of most firms, typically a share far larger than that of raw materials costs, subdued unit labor costs should remain a restraining influence on inflation. To be clear, I am not arguing that healthy increases in real wages are inconsistent with low inflation. The two are perfectly consistent so long as productivity growth is reasonably strong. The second additional factor restraining inflation is the stability of longer-term inflation expectations. Despite the recent pickup in overall inflation, measures of households' longer-term inflation expectations from the Michigan survey, the 10-year inflation projections of professional economists, the 5-year forward measure of inflation compensation derived from yields on inflation-protected securities, and other measures of longer-term inflation expectations have all remained reasonably stable. As long as longer-term inflation expectations are reasonably stable, increases in global commodity prices are unlikely to be built into domestic wage and price-setting processes, and they should therefore have only transitory effects on the rate of inflation. That said, the stability of inflation expectations is ensured only as long as the commitment of the central bank to low and stable inflation remains credible. Thus, the Federal Reserve will continue to closely monitor the evolution of inflation and inflation expectations and will take whatever actions are necessary to keep inflation well controlled. As I noted earlier, the rise in commodity prices has directly increased the rate of inflation while also adversely affecting consumer confidence and consumer spending. So let me take a look at those prices in a little bit more detail. The basic facts are familiar. Oil prices have risen significantly, with the spot price of West Texas Intermediate near $100 per barrel as of the end of last week, up nearly 40% from a year ago. Proportionally, prices of corn and wheat have risen even more, roughly doubling over the past year. And prices of industrial metals have increased notably as well, with aluminum and copper prices up about 1/3 over the past 12 months. When the price of any product moves sharply, the economist's first instinct is to look for changes in the supply of and demand for that product. And indeed, the recent increase in commodity prices appears largely to be the result of the same factors that drove commodity prices higher throughout most of the last decade: strong gains in global demand that have not been met with commensurate increases in supply. From 2002 to 2008, a period of sustained increases in commodity prices, world economic activity registered its fastest pace of expansion in decades, rising at an average rate of about 4.5% per year. This impressive performance was led by the emerging and developing economies, where real activity expanded at a remarkable 7% per annum. The emerging market economies have likewise led the way in the recovery from the global financial crisis. From 2008 to 2010, real GDP rose cumulatively by about 10% in the emerging market economies, even as GDP was essentially unchanged on net in the advanced economies. Naturally, increased economic activity in emerging market economies has increased the global demand for raw materials. Moreover, the heavy emphasis on industrial development in many emerging market economies has led their growth to be particularly intensive in the use of commodities, even as the consumption of commodities in advanced economies has stabilized or declined. For example, world oil consumption rose by 14% from 2000 to 2010. Underlying this overall trend, however, was a 40% increase in oil use in emerging market economies and an outright decline of 4.5% in the advanced economies. In particular, U.S. oil consumption was about 2.5% lower in 2010 than in 2000, with net imports of oil down nearly 10%, even though U.S. real GDP rose by nearly 20% over that period. This dramatic shift in the sources of demand for commodities is not unique to oil. If anything, the pattern is even more striking for industrial metals, where double-digit percentage rates of decline in consumption by the advanced economies over the past decade have been overwhelmed by triple-digit percentage increases in consumption by emerging market economies. Likewise, improving diets in the emerging market economies have significantly increased their demand for agricultural commodities. Importantly, in noting these facts, I am intending no criticism of emerging markets. Growth in those economies has conferred substantial benefits, both within those countries and globally. And in any case, the consumption of raw materials relative to population in emerging market economies remains substantially lower than in the United States and in other advanced economies. Nevertheless, it is undeniable that the tremendous growth in emerging market economies has considerably increased global demand for commodities in recent years. Against this backdrop of extremely robust growth in demand, the supply of many commodities has lagged behind. For example, world oil production has increased less than 1% per year since 2004, compared with nearly 2% per year in the prior decade. In part, the slower increase in the supply of oil reflects disappointing rates of production in countries that are not part of OPEC. However, OPEC has not shown much willingness to ramp up production either. Most recently, OPEC production fell 1.3 million barrels per day from January to April of this year, reflecting the disruption to Libyan supplies and the lack of any significant offset from other OPEC producers. Indeed, OPEC's production of oil today remains about 3 million barrels per day below the peak of mid-2008. With the demand for oil rising rapidly and the supply of crude stagnant, increases in oil prices are hardly a puzzle. Production shortfalls have plagued many other commodities as well. Agricultural output has been hard hit by a spate of bad weather around the globe. For example, last summer's drought in Russia severely reduced that country's wheat crop. In the United States, high temperatures significantly impaired the U.S. corn crop last fall, and dry conditions are currently hurting the wheat crop in Kansas. Over the past year, droughts have also afflicted Argentina, China, and France. Fortunately, the lag between planting and harvesting for many crops is relatively short. Thus, if more typical weather patterns resume, supplies of agricultural commodities should rebound, thereby reducing pressure on their prices. Not all commodity prices have increased, illustrating the point that supply and demand conditions can vary across markets. For example, prices for both lumber and natural gas are currently near their levels of the early 2000s. The demand for lumber has been curtailed by weakness in the U.S. construction sector, while the supply of natural gas in the United States has been increased by significant innovations in extraction techniques. Among agricultural commodities, rice prices have remained relatively subdued, reflecting favorable growing conditions. In all, these cases reinforce the view that the fundamentals of global supply and demand have been playing a central role in the recent swings in commodity prices. That said, there is unusually significant uncertainty about current and prospective supply and demand. Accordingly, commodity prices, like the prices of financial assets, can be volatile as market participants react to incoming news. Recently, commodity prices seem to have been particularly responsive to news bearing on the prospects for global economic growth, as well as geopolitical developments. As the rapid growth of emerging market economies seems likely to continue, should we therefore expect continued rapid increases in the prices of globally traded commodities? While it is certainly possible that we will see further increases, there are good reasons to believe that commodity prices will not continue to rise at the rapid rates that we have seen recently. In the short run, the unexpected shortfalls in the supplies of key commodities result in sharp price increases, as usage patterns and available supplies are difficult to change quickly. Over longer periods, however, high levels of commodity prices curtail demand as households and firms adjust their spending and production patterns. Indeed, as I noted earlier, we have already seen significant reductions in commodity use in the advanced economies. Likewise, over time, high prices should elicit meaningful increases in supply, both as temporary factors such as adverse weather abate and as investments in productive capacity come to fruition. Finally, because expectations of higher prices lead financial market participants to bid up the spot prices of commodities, predictable future developments bearing on the demands for and supplies of commodities tend already to be reflected in current prices. For these reasons, although unexpected developments could certainly lead to continued volatility in global commodity prices, it is reasonable to expect the effects of commodity prices on overall inflation to be relatively moderate in the medium term. While supply and demand fundamentals surely account for most of the recent movements in commodity prices, some observers have attributed a significant portion of the run-up in prices to Federal Reserve policies, over and above the effects of those policies on U.S. economic growth. For example, some have argued that accommodative U.S. monetary policy has driven down the foreign exchange value of the dollar, thereby boosting the dollar price of commodities. Indeed, since February 2009, the trade-weighted dollar has fallen by about 15%. However, since February 2009, oil prices have risen 160%, and non-fuel commodity prices are up about 80%, implying that the dollar's decline can explain, at most, only a small part of the rise in oil and other commodity prices. Indeed, commodity prices have risen dramatically when measured in terms of any of the world's major currencies, and not just the dollar. But even this calculation overstates the role of monetary policy, as many factors other than monetary policy affect the value of the dollar. For example, the decline in the dollar since February 2009 that I just noted followed a comparable increase in the dollar, which largely reflected flight to safety flows triggered by the financial crisis in the latter half of 2008. The dollar's decline since then, in substantial part, reflects the reversal of those flows as the crisis eased. Slow growth in the United States and a persistent trade deficit are additional, more fundamental sources of recent declines in the dollar's value. In particular, as the United States is a major oil importer, any geopolitical or other shock that increases the global price of oil will worsen our trade balance and economic outlook, which in turn tends to depress the dollar. In this case, the direction of causality runs from commodity prices to the dollar rather than the other way around. The best way for the Federal Reserve to support the fundamental value of the dollar in the medium term is to pursue our dual mandate of maximum employment and price stability, and we will certainly do that. Another argument that has been made is that low interest rates have pushed up commodity prices by reducing the cost of holding inventories, thus boosting commodity demand, or by encouraging speculators to push commodity futures prices above their fundamental levels. In either case, if such forces were driving commodity prices materially and persistently higher, we should see corresponding increases in commodity inventories, as higher prices curtailed consumption and boosted production relative to their fundamental levels. In fact, inventories of most commodities have not shown sizable increases over the past year as prices rose. Indeed, increases in prices have often been associated with lower rather than higher levels of inventories, likely reflecting the strong demand or weak supply that tends to put pressure on available stocks. And finally, some have suggested that very low interest rates in the United States and other advanced economies have created risks of economic overheating in emerging market economies and have thus indirectly put upward pressure on commodity prices. In fact, most of the recent rapid economic growth in emerging market economies appears to reflect a bounce back from the previous recession and continuing increases in productive capacity as their technologies and capital stocks catch up with those in advanced economies, rather than being primarily the result of monetary conditions in those countries. More fundamentally, however, whatever the source of the recent growth in the emerging markets, the authorities in those economies clearly have a range of fiscal, monetary, exchange rate, and other tools that can be used to address any overheating that may occur. As in all countries, the primary objective of monetary policy in the United States should be to promote economic growth and price stability at home, which in turn supports a stable global economic and financial environment. Well, thank you for your patience. Let me conclude now with a few words about the current stance of monetary policy. As I've discussed today, the economic recovery in the United States appears to be proceeding at a moderate pace, and notwithstanding unevenness in the rate of progress and some recent signs of reduced momentum, the labor market has been gradually improving. At the same time, the job situation remains far from normal, with unemployment remaining elevated. Inflation has risen lately, but should moderate, assuming the commodity prices stabilize and that, as I expect, longer-term inflation expectations remain stable. Against this backdrop, the Federal Open Market Committee has maintained a highly accommodative monetary policy, keeping its target for the federal funds rate close to zero and further easing monetary conditions through large-scale asset purchases. The FOMC has indicated that it will complete its purchases of $600 billion of Treasury securities by the end of this month, while maintaining its existing policy of reinvesting principal payments from its securities holdings. The committee also continues to anticipate that economic conditions are likely to warrant exceptionally low levels for the federal funds rate for an extended period. The U.S. economy is recovering from both the worst financial crisis and the most severe housing bust since the Great Depression, and it faces additional headwinds ranging from the effects of the Japanese disaster to global pressures in commodity markets. In this context, monetary policy cannot be a panacea. Still, the Federal Reserve's actions in recent years have doubtless helped stabilize the financial system, ease credit and financial conditions, guard against deflation, and promote economic recovery. All of this has been accomplished, I should note, at no net cost to the federal budget or to the U.S. taxpayer. Although it is moving in the right direction, the economy is still producing at levels well below its potential. Consequently, accommodative monetary policies are still needed. Until we see a sustained period of stronger job creation, we cannot consider the recovery to be truly established. At the same time, the longer-run health of the economy requires that the Federal Reserve be vigilant in preserving its hard-won credibility for maintaining price stability. As I have explained, most FOMC participants currently see the recent increase in inflation as transitory and expect inflation to remain subdued in the medium term. Should that forecast prove wrong, however, and particularly if signs were to emerge that inflation was becoming more broadly based or that longer-term inflation expectations were becoming less well anchored, the committee would respond as necessary. Under all circumstances, our policy actions will be guided by the objectives of supporting the recovery in output and employment while helping to ensure that inflation, over time, is at levels consistent with the Federal Reserve's mandate. Thank you very much. There is a certain amount of variance across the nation in terms of unemployment, in terms of growth. Certain states, North Dakota comes to mind, have very low unemployment rates, others much higher. One of the main characteristics of the states with high unemployment is that they experience bigger booms and busts in the housing market. So you have some states where the housing market has fallen very sharply, and the impact on consumer spending, confidence, on construction, and so on has made the recession and the worse and the recovery slower in those states. With respect to the dollar, first, in the medium term, any international finance textbook will tell you that the exchange rate has two parts. It has, first of all, the inflation differential, the difference between inflation at home and inflation abroad. And then it has what's called the real exchange rate, which reflects real factors such as productivity growth, for example. In the United States, the Federal Reserve has been successful in keeping inflation low and stable since the late 1980s. Indeed, since the mid-90s, inflation in the U.S. has been lower than in other economies, and it's lower than many other economies today. So the Federal Reserve's efforts to keep inflation low, and in particular, in many cases lower than our trading partners, is a positive factor for the dollar. Likewise, the real exchange rate depends greatly on the attractiveness of the U.S. economy for foreign capital flows. So again, to the extent that the economy is growing and there are attractive investment opportunities, that will attract foreign capital flows and that will strengthen the dollar. So there's a very strong case that what the Fed needs to do to provide good fundamentals for the dollar in the medium term is first to keep inflation low and stable, and secondly, to help the economy recover and be strong. And that is exactly the Federal Reserve's mandate, which is why I see no inconsistency whatsoever between achieving our dual mandate and providing a good fundamental backdrop for the dollar. Now, it's also true that the dollar fluctuates over the short run, but they're temporary fluctuations. If you look at the history of the dollar, you see there are many periods of sharp movements up and down. Recently, there have been two factors in particular. One has been, as I mentioned before, the flights to quality as the world, as investors around the world have experienced greater risk aversion during certain periods, such as the crisis period in the fall of '08, the dollar becomes very attractive because of the depth and liquidity of U.S. financial markets, and that those periods of risk off have caused the dollar to appreciate very strongly. Then when that risk pattern is reversed and people become more comfortable, the dollar tends to reverse that pattern, and we've seen that several times during the crisis. The other factor which is affecting the dollar is the fact that the U.S. economy is in a quite weak cyclical position relative to, particularly to emerging markets, including Asia at this point. And that is the fundamental reason why, at this moment, returns are perceived as lower in the U.S. than in other economies. Again, the best way to deal with that, fundamentally, is to help the U.S. economy recover. A strong U.S. economy will support the fundamentals for the dollar, and it will also be good for the world economy, because the world economy, notwithstanding tremendous growth around the world, still depends significantly on a healthy U.S. economy.
Where would you come down choosing to withdraw fiscal stimulus, to have a pay down to the capital markets that the fiscal problems will resolve, or say, no, that would be too impactful and therefore we should keep the stimulus?
Well, you're asking me to choose between two very inferior outcomes, and I prefer not to do that. Again, let me reiterate what I said, if you don't mind, which is that our problems, it's very important to understand that while our fiscal deficit this year is extraordinarily high, a great deal of that is due to the weakness of the economy, and that will, some of it at least, will vanish as the economy strengthens. Fundamentally, the U.S. fiscal problem is a long-term problem, and it should be addressed on a long-term basis. And we can do that in a way that is credible, that persuades bond markets that the U.S. government is sincere about bringing its finances under control, but we can do that in a way that doesn't create an unnecessary short-term fiscal shock, and again, I would advocate for an appropriate balance between those two objectives. While it is true that there are a lot of regulations in the pipeline, there's a good reason why financial regulation has been reformed. As you know, of course, we've just been through the worst financial crisis since the Great Depression, and the reasons for that crisis were very diverse. There are very many reasons, but certainly gaps and problems in the financial regulatory system were part of the problem. And therefore, it is very important that we, as we have done, take a long look at our financial regulatory system and try to improve it and strengthen it so that we significantly reduce the risk of a future crisis, and if a crisis occurs, increase the resilience of the system so that the impact on the economy would be less. So it's very important that we address those issues, and we are trying to do that. Now, reducing the risk of crisis is an important objective, and we need to take action to do that. We would like to do that in a way that minimizes the impact on credit availability, knowing that we won't always succeed, but in several ways we're trying to do that. One in particular, the Federal Reserve, as we develop our regulations and rules, of course we go through a comment process and we get input through a lot of different mechanisms, and we are certainly trying to develop regulations and the accompanying supervisory structure in a way that will have maximum impact on reducing financial risk and increasing financial resiliency, while minimizing as much as possible the impact on the legitimate and important functions of the banking system and the financial system. So we are very attentive to that issue. And I think anyone who's worked with the Federal Reserve would confirm that. The second thing that we are doing broadly is we are working with the international community. We want to make sure that there are not or there are minimal number of inconsistencies across jurisdictions, that as much as possible we can develop a level playing field, that we can leave open space for good competition and innovation in the global financial system. So we're working carefully with our international partners, and in particular one aspect of that in the Basel III rules, which of course involve both capital and liquidity, we are phasing those in very slowly, and that is one reason we're doing that, of course, besides giving banks a reasonable amount of time to develop the appropriate systems and so on, is to minimize the near-term effects on credit costs and credit availability. So we're looking at both of those things, but we have a trade-off. We certainly have to take those actions necessary to reduce the risk of crisis. Conditional on that, we'll do all we can to minimize the impact on costs and on credit availability. I had a very productive meeting, by the way, with Monsieur Barnier just the other day, and we discussed the collaboration between the U.S. and Europe on financial regulatory reform, and we are the two jurisdictions, the United States and Europe, are strongly committed to working together to create as consistent a system as possible. Cross-border resolution is one of the most difficult problems that we have. Of course, currently we have different bankruptcy laws, different systems, not only, say in this case, between the United States and Europe, but within Europe and within many jurisdictions around the world. And so there's some very challenging problems to be solved there. I'll just say two things about that. One is that there is a serious effort ongoing, both here and in Europe, to improve the resolution process. As you know, Dodd-Frank includes a resolution plan, a resolution set of rules. The FDIC, and Sheila Bair is talking about this quite a bit, the FDIC is taking a lead role in trying to develop the information and the skills and the tools it needs to resolve a large failing financial institution, one of those tools being the living will, which you probably are familiar with. As part of that process, she and others in the U.S. regulatory community have been in close contact with our counterparts, mostly in Europe, trying to establish agreements and ways of working together so that we can address a circumstance that would arise if there were a multinational firm in stress. But more specifically, the Europeans are, in fact, and through the Basel Committee, are trying to address this directly by developing resolution mechanisms for Europe. So I would say this is a long process because there are many legal issues to be addressed, and we're dealing with very complex firms, et cetera. But we have to start somewhere, and I think a good start has been made. I would add in addition to that that many of the regulations, capital requirements, liquidity requirements, and things that were mentioned in the earlier question really are complementary. We want to reduce the excessive risk-taking by large financial firms and reduce their risk of failure and increase the resilience of the system to a failure. So that's complementary to the resolution regime, and if possible, we would like to avoid getting into a resolution situation if at all possible. So that is a very difficult process, but we are, we have made a good beginning, and we'll continue to work with our partners internationally, thinking about specific firms, but also thinking about legal frameworks for resolution. You mentioned derivatives and other financial instruments. There are, at this point, there are some areas where, at least at the moment, we don't have full consistency across jurisdictions. As you know, the United States recently issued some rules on over-the-counter derivatives, which include some requirements that are not yet part of the law, part of practice in Europe. What I'd like to say about that is that we are very aware of these discrepancies. We certainly do not want to create unlevel playing fields. We certainly do not want to create incentives for firms or market participants to switch jurisdictions in order to avoid certain regulatory requirements. And therefore, we are very committed, again, to working with our partners internationally to try to achieve as much consistency as possible. And we will continue to work on that. And please don't worry that we've somehow neglected that point. we've heard a great deal from bankers, among others, about the inconsistencies that already exist, and we really have a full court press in place to try to find ways to minimize those differences. Just on the issue of distortions, that is a concern. It certainly is. Vice Chair Yellen gave a speech just a few days ago talking about what the Federal Reserve is doing on this front. My view on this, and this goes back to the very first speech I ever gave as a governor on the board, is that to the extent possible, you want to use the right tool for the job, and the first line of defense, to mix my metaphors, the first line of defense against asset price distortions is good supervision and regulation. And we at the Federal Reserve, and along with other regulators, have greatly stepped up our game in terms of our ability to monitor what's happening in the financial system. And we take these issues very, very seriously. And Janet's speech talked in some detail about some of the tools that we have, the institutional changes we've made, the enormous increase in resources we put into monitoring the financial system and the like. And in most cases where we have identified problems, they can be addressed through regulatory or supervisory means. And that would be far preferable than using the interest rate tool, which is a very blunt tool and which is better directed at macroeconomic stability than at financial stability. So that would be our first choice. If those tools fail, then we'll have to think further. But right now, we believe that using supervisory and regulatory tools and monitoring, plus the strengthening of the system, as we've been talking about, will be a sufficient response. On shadow banking is a very broad term and includes many different kinds of institutions. Many of them are being addressed to some extent by the changes in the rules. For example, there have been reforms bearing on money market mutual funds, which are the deposit side, in some sense, of the shadow banking system. There's been toughening of the accounting rules to force banks to take more off balance sheets onto their balance sheet, or have strengthened securitization rules, et cetera, et cetera. So in fact, the rules and regulations are addressing many aspects. And more broadly, of course, with a macroprudential approach, that is an approach by regulators which focuses on the stability of the overall system, both the Federal Reserve individually and the Financial Stability Oversight Council collectively have the authority and the responsibility to monitor what's happening throughout the financial system and to take action as needed. So while we are, certainly far from omniscient, and there'll no doubt be many things that we will not see, the attitude is very different than what it was 5 years ago. We are much more committed towards systemic stability, and the idea that once the problem leaves the particular institution that you're supervising, it's somebody else's problem, that attitude is gone. We are now thinking very much collectively and cooperatively about the stability of the overall system. So, I do think that we are addressing shadow banking issues, and I'll conclude my answer to your question by noting that, once again, this is an international process, and the Basel network, the Basel committees are looking at including the Financial Stability Board, are looking at shadow banking as well, and there will probably be international recommendations to apply to shadow banking. First, a word about the liquidity regime in general, then I'll address your specific question. We've been working with capital requirements for 20 years. We're just beginning to think about liquidity, so clearly we're at very early stages conceptually and practically in understanding how to impose liquidity regulation. That being said, I think that we really did have to act in this area given what we saw during the crisis, where liquidity was often one of the precipitating issues in the panic. Let me just say about the process on liquidity, the Basel process on liquidity. It is a process that we're moving very slowly on it. We have this extended so-called observation period. The rules do not take place, I think, until 2015. So the number of things we want to do as we go forward. First, we want to make sure that we have the right structure. Currently there is this double structure, the LCR and the NFSR, the short-term and long-term liquidity rules. Is that the right structure? That requires still some more thought, conceptual analysis. A point which a number of bankers have made is that in some cases the calibration may not be right. That is, the weightings given to certain types of liquidity instruments may need to be rethought, and we are looking at those as well. And finally, and this has been a particular concern of the Federal Reserve, as we make these changes, we require banks, for example, to hold more liquidity or to have more long-term liabilities. What are the implications of that for the broader financial system? What are the implications for the commercial paper market, for the money market mutual funds, and so on? And so we need to do more thinking, and we are doing so both at the Federal Reserve but also through the Basel process about the so-called general equilibrium effects of liquidity rules. So there's a lot of work to be done on this. Again, the basic principle that we need to address the issues of liquidity that were revealed by the crisis is still there and very important, but we recognize that it's going to take some time and some experimentation to get a regime that is both effective and also doesn't impose excessive costs on the overall financial system. So that process is ongoing. In terms of individual countries, the United States, perhaps like Australia, has many unique features that other countries don't have. I don't know what other countries ever heard of a Federal Home Loan Bank, for example, and many other elements of our banking system. And so, of course, there is no formal agreement, no legal agreement that requires each country to have precisely the same rules. And within general bounds, and with good reason, there will be divergences across countries relating to institutional differences and differences in philosophy. Because in the end, these rules are national in character. They really are not international in their legal basis. Jamie, please.
Yeah, Mr. Chairman, Jamie Dimon, JPMorgan Chase. I have this completely agree that we had a crisis, and it means we should do a lot of things to fix it and reduce risk. I have this great fear that someone's going to write a book in 10 or 20 years, and the book is going to talk about all of the things that we did in the middle of a crisis to actually slow down recovery. I don't personally buy the argument that because it was a financial crisis, it has to take a long time coming out. So I made a list of all the things that have already been done and a few things that are going to be done. So the already done, most of the bad actors are gone. They were thrifts, all the mortgage brokers, and obviously some banks. Off-balance sheet businesses are virtually obliterated. Some are gone, CIVs. A lot of the insurers that used to guarantee them are gone. CDOs are gone. Money market funds are far more transparent. Most very exotic derivatives are gone. There's far more transparency in any remaining kind of off-balance sheet thing. Fannie Mae and Freddie Mac are in the government hospital. Higher capital and liquidity are already in the marketplace. We estimate more than double than what is before. There are tougher requirements. Boards are tougher. Risk committees are tougher. There's an oversight committee. Regulators, I can assure you, are much tougher in every way, shape possible. One of the cores of the problem was mortgage underwriting. Mortgage underwriting has gone back to what it was 30 years ago. I think it's a good thing, but there's no more subprime. There's no more Alt-A. There's no more mortgage being packaged. The CMBS market's been completely reformed. There's far more transparent accounting. We've been through 2 stress tests, one at the Treasury, one at the Fed. I believe most of the banks passed the recent ones with flying colors, partially for the reason I just said. Now we're told there could be even higher capital requirements, so-called SIFI charges and G-SIFI charges, et cetera. And we know there are 300 rules coming. Has anyone bothered to study the cumulative effect of all these things? And do you have a fear like I do that when we look back and look at them all, that they will be a reason that it took so long that our banks, our credit, our businesses, and most importantly, job creation start going again? Is this holding us back at this point?
Well, Jamie, that list you gave me made me feel pretty good there for a while because it sounded like we're getting a lot done.
Yes, I agree.
That's great. Well, the crisis revealed lots of weak spots, lots of problems, and we are, it's a comprehensive, this is certainly the most comprehensive financial reform since the 1930s, and we are trying to execute it, and we're trying to address all of the problems, and there, you didn't mention 3 or 4 others I could think of. Yes, it was a big problem. It had a huge impact. There were many, many sources. I think one of the, just as a sort of just a pet peeve, is that many people try to say the single cause of the crisis was X. There was no single cause of the crisis. There were many, many different causes, and they interacted in a way that was in many ways unpredictable and led to the disaster that we experienced. So there are many, many things to fix, and we are working on it and making, I hope, a lot of progress. Has anybody done a comprehensive analysis of the impact on credit? I can't pretend that anybody really has. It's just too complicated. We don't really have the quantitative tools to do that. What we are trying to do, I would say, is two things. One is that we are trying, and I'll speak for the Federal Reserve, we are trying to move as expeditiously as we can to develop a new framework, as expeditiously as we can, consistent with doing it right. We're trying to develop rules that make sense, that are consistent with good practice, but which do not unnecessarily impose costs or unnecessarily constrict credit. The second thing, and this I realize many of you here are heads of large institutions, but you think it's difficult for J.P. Morgan Chase. It's very, very difficult for the small banker, for the community banker, and we have set up a number of different screens, filters, committees, processes in the Federal Reserve to try to make sure that when new rules are put in place, that the smaller institutions are sheltered from them as much as possible, unless there's a necessary impact. So I hear what you're saying. We're going to do our very best. There's a trade-off there. We have to take steps to make sure that we don't have a repeat of what happened. I think we can do that in a way that preserves the key functions of banking, that allows credit to be extended, it allows the basic financial services to be extended. But there is some trade-off there, and you're right to point that out. And it's probably going to take a little bit of time before we, over time, figure out, where the cost exceeds the benefit, and we make the appropriate adjustments. But to answer your question, nobody's looked at it in all detail, but we certainly are trying, as in each part, to develop a system that is coherent and that is consistent with banks performing their vital social functions of extending credit and providing other key financial services.